Hello, I'm David Hardesty. In this lecture, we continue our discussion of website development costs with a detailed look at how to identify and differentiate between Section 263 costs and Section 162 costs. Before studying this lecture, please first study two other lectures, if you have not already done so. Lecture 2-1, Overview of Accounting for Website Development Costs, and Lecture 2-2, Accounting for Software Costs in Websites. The objectives of this lecture are to understand the basic rules for characterizing website development costs as currently deductible Section 162 ordinary and necessary business expenses. Understand the basic rules for characterizing website development costs as Section 263 capitalized costs. And understand the manner in which the intangibles regulations control characterization of costs associated with intangibles as either Section 162 or 263 costs. The reading in the text associated with this lecture is at Electronic Commerce, Taxation and Planning 7.03. Let's first discuss Section 162 expenditures. As discussed in the text at 7.03, the Code allows a current deduction for Section 162 expenses. To qualify as deductible under Section 162, costs must be ordinary and necessary costs, incurred in carrying on a trade or business, and not subject to special treatment under other code sections, such as Sections 163, 164, 174, 263, and so on. What this means for practical purposes is any costs incurred in carrying on a business which are not subject to the requirements of other specific code sections often default to Section 162 classification. Website costs that are not capitalized under Section 263 and are ordinarily not subject to Sections 163, 164, or 174 are often characterized as Section 162 costs. Note, it is important to remember that Section 162 expenses of a startup company, which are otherwise currently deductible, are deferred under Section 195. Now let's switch our focus to Section 263 costs. The Code requires a taxpayer to capitalize Section 263 costs. In general, Section 263 costs are amounts paid or incurred to acquire property, add to the value or substantially prolong the useful life of property, to adapt property to a new and different use. Under special regulations, a taxpayer must also capitalize under Section 263 amounts paid or incurred to create or acquire an intangible, facilitate the creation or acquisition of an intangible, or create or enhance a future benefit identified in published guidance as requiring capitalization. We will now look at the general rule for capitalization and then later discuss the special rules for intangibles. The first of the general rules is the separate and distinct asset test under Section 263. As discussed in the text at 7.032, under the general rule, an expenditure is capitalized under Section 263 only if it serves to acquire, create, or enhance a separate and distinct asset. This means that if there's no specific asset that can be identified as being created or enhanced, then Section 263 ordinarily does not apply. Examples of separate and distinct assets in websites are furniture, fixtures, leasehold improvements, and equipment, software, either self-developed or purchased, database content, website content, investments in other companies, purchased intangibles such as copyrights, patents, trademarks, trade names, domain names, licenses, and franchise, self-created intangibles such as copyrights and patents, rights, including prepaid rights to services, know-how, customer lists. Note that many of these assets are intangibles that are subject to the intangibles regulations discussed in the remainder of this lecture. Most of the difficulty in differentiating Section 162 and 263 website development costs relates to intangibles. So this is what we will discuss in the remainder of this lecture. Capitalization of intangibles is controlled by the intangibles regulations discussed in the text at 7.038. The intangibles regulations identify specific intangibles costs that must be capitalized. In general, if costs associated with the acquisition, creation, or enhancement of an intangible are not required to be capitalized under these regulations, then the cost is deducted under 162, assuming it is not subject to some other code section, such as Section 174, and is not a software development cost subject to Revenue Procedure 2050. Here's an overview of the intangibles regulations. As discussed in the text at 7.038, a taxpayer must capitalize amounts paid to acquire or create intangible assets. In addition, a taxpayer must capitalize amounts paid to facilitate the acquisition or creation of such assets. The intangibles to which they refer are specifically identified by the regulations and do not include all of what we might consider intangibles. Let's look first at acquired intangibles. The cost of most acquired intangibles must be capitalized, whereas the cost of only certain created or enhanced intangibles is capitalized. If an intangible is acquired, than its cost is ordinarily subject to capitalization under the regulations. There is an exception for intangibles having a useful life of a year or less. The following are examples of acquired intangibles. An ownership interest in a corporation, partnership, trust, estate, LLC, or other similar entity. Various financial interests. A lease contract. A patent, copyright, franchise, trademark or trade name. An assembled workforce. Goodwill or going concern value. A customer list. A servicing right. A customer or supplier-based intangible. Computer software, including both canned and custom software. And an agreement providing for the use of an intangible. Now let's turn to the cost of created intangibles. The regulations severely limit the cost of created intangibles that must be capitalized. The intangibles are limited to a cost to create an ownership interest in entities and various financial interests, and costs to create separate and distinct intangible assets. Separate and distinct intangible assets are a property interest with ascertainable and measurable value in money's worth that is subject to protection under applicable state, federal, or foreign law, and the possession and control of which is intrinsically capable of being sold, transferred, or pledged separate and apart from a trade or business. A key question is what costs must be included in the capitalized cost of an asset. A particular problem arises in determining whether wages and overhead must be capitalized. As explained in the text at 7.03.4, as a general rule, wages that are directly related to the acquisition or improvement of an asset must be capitalized. For intangibles, including website development costs that are subject to the intangibles regulations, wages and overhead associated with creating separate and distinct intangible assets must be capitalized. See the text at 7.038CI. There is an exception for wages and overhead that facilitate the acquisition or creation of intangible assets. Such costs need not be capitalized as explained in the text at 7.038CI. Once a cost is capitalized, the question arises as to how to deduct the cost. The capitalized cost of a tangible asset is generally subject to depreciation under Section 168. The capitalized cost of intangible assets is amortized under a variety of rules. Capitalized intangibles are, by default, amortized over their economically useful lives under Section 167, as explained in the text at 7.074. Certain acquired intangibles, however, are amortized over 15 years under Section 197 as explained in the text in Chapter 8. A limited number of created intangibles are amortized over 15 years at the election of the taxpayer if there is no other rule that applies, as explained in the text at 7.038A2. Note: software development costs are amortized under Revenue Procedure 2050, and Section 174 costs are amortized under Section 174, as explained in an earlier lecture.